Okay, so I'm going through the solution of E10-8. If you haven't tried this on your own, please do that. It's really good practice. Once you've done it, you can watch this video. So this question looks at Murray's Demolition in Hamilton, Ontario. And it goes through, tells us about the company. And it says that they spent $140,000 on a truck. It's expected to be useful to the business for 4 years, at which time it should be able to be sold at $60,000. So estimated useful life in years is 4 years, and residual value is $60,000. It says they've always used the straight line basis for calculating amortization. New owners want to see what the amortization schedules under the different methods would use. And they said they also think the truck could be useful for 200,000 kilometers. So we're going to use that for our units of production, and then it gives the different kilometers driven in the different years. And it asks at the end, is there a problem for continuing the straight line method? Okay, so we need to calculate each method and look at the amortization. So we can see here, I've got the straight line method first, and this is in the chart format. If you used the T-account way, that is fine as well. You would get through the same thing. So using this chart, we're using the amortization rate, as you can see here. And this is calculated as 1 divided by 4 years, because that was the estimated useful life. So the 1 over 4, that gives us 20%. And that is where the amortizable cost then comes in, or we could times this 20% by that amortizable cost, which remember is our cost. What's going on here? Cost minus the residual value. So that is the $140,000 cost minus a $60,000 residual value, and that gets us to the $80,000. So that is the amortizable cost that is being used here. So if we use the other formula in class, which was our cost minus residual, then we would divide this by 4 years, and that gets us the $20,000. So either way, if you times 20% by 80,000 or divide 80,000 by 4, it's doing the same thing. So each year we have the same amount of expense, which is 20,000. So at the end of this first year, 2020, we book 20,000 in expense. Since we have a 0 as our opening accumulated, 0 plus 20 gets us 20, and the book value is our cost minus, not minus residual, minus the accumulated amortization. So $140,000 cost minus the 20 gets you to $120,000. So you do this each year, and in this case it's $20,000 every year. So we're adding that, and then take 140 minus the accumulated to get your book value each time. So at the end of our 4 years, this is year 1, 2, 3, and 4, we've got a total amortization expense, if we add these up, equal to the $80,000. So that's our accumulated, that's our total expense booked, and our book value is $60,000, which is equal to the residual value. So we know that we're good. Even if we continue using this item, we'd stop here because we stop where the residual value and the book value are equal. So that's the straight line, same amount each year. Then we see next using the units of production. So for this method, the first thing we needed to do was calculate this fixed per unit cost, because we're going to multiply this by the number of kilometers driven by that truck each year. So we take the cost minus the residual and divide it by the estimated useful life, but now in units of production. And in that case, it was 200. So our $80,000 amortizable cost divided by 200,000 kilometers, we get 40 cents per kilometer. So we're going to use this amortization per kilometer, and then we multiply it by the number of kilometers actually driven in the year, and that gets us the amortization expense that we would book each year. So the question said that there were 60,000 kilometers the first year, 50 in the second, 50 in the third, and then 40,000 in this fourth year. But again, the reason then it works out in this question, we're stopping because we've got to 200,000 kilometers, and that equaled our estimate. And we're stopping because our book value at this point equals the residual value. So figured it out each year. We got our expense, figured the accumulated, got the book value. And then in this fourth year, that was when our residual value got to the book value, so we stopped there. So this one, again, not too tricky because it didn't give you, or the kilometers worked out in those 4 years. The final method looks at the double declining. Now this is one where you really had to be careful as you were going. So double declining rate, we figure that out as the straight line rate times 2. So our straight line rate we saw above was 1 divided by the estimated useful life, and that equaled the 20%. And then we multiply, and you guys were probably screaming at me. I didn't even think about that. I don't know where I got 20% from. That wasn't even bad math. I just wrote that number. 1 divided by 4 years is in fact 25%, not 20%. I think I was thinking back to the previous video. Okay, so now the straight line rate, the 1 over 4, or the 25%, we're using double declining, so we multiply that by 2, and that gets us this 50% that we see there and see in the question. So double declining, you use that rate, but we're multiplying by the book value of the asset. So we don't really need it in the first year. The first time we record amortization is December 31st, 2020. So we take this rate of 50% and don't times it by the amortizable cost, times it by the book value. In the first year, our book value is the 140 because we have no amortization yet. So 50% times 140 equals 70,000 of amortization expense in that first year. So that's our accumulated, and it gets us to a book value of $70,000. So that is the value that you now carry and we use here in this column. So here it shows the adjustment. But if you said, well, in year 2, I need to take 50,000 times 70,000, 50% times 70,000, you would get 35,000. But if you book that full amount, we're now at 105,000 for our accumulated amortization, which gets us only to a book value of 35,000. And that is too low because we know we stop when the book value gets to the residual. So in this case, even though that's what you calculate out, we know that we can't use those amounts. We actually need to only get to this $10,000. That's the max we can do because that gets us to an accumulated of 80,000 and our book value of 60,000. So this equals the residual value. We've already gotten there in 2 years. So in that case, that is where we stop. That's the maximum amount of amortization that we're going to record. So after that, you just have $0. And this continues down at 80,000. So at the end of year 4, we're still at that residual value of 60,000. So you needed to be careful on this one, and you need to in the future, here as well as in possible units of production, that you stop or you only record the amount of the expense that gets you to the residual value. So if you get to a year where your calculation gives you a higher amount, you need to stop at that point. And we saw in our other example, we had got to the end of those 5 years and we just had to subtract. So we actually needed more to get to this 60,000. So you could see either way, that you get to that amount early or you get to it in your calculations, it would be too late. So be careful of that on these examples. We can compare these 3 methods because the question asks, is there a problem continuing to use the straight line method? Well, if we go through and we compare these different methods, we can see that each year in straight line we booked 20,000. For units of production, we booked 24, then 20, then 20, and then 16, just depending on the kilometers driven. Whereas double declining, we had 70,000 in the first year, 10 in the second, and then it was fully amortized to that residual value, so we stopped. So in this case, we know that we still had that truck because we were still driving it in year 4. So the double declining balance for this item would not be a good method because we were able to drive it for 2 years without having any amortization to book. Whereas straight line and units of production, these would both be okay because we can see that they're fairly similar. At the end of the years, we're at the 80 and they're pretty close each year. So either of the methods would be okay for this truck because it seems to be matching the expenses with the revenue and the benefits of its life over these years. Okay, so that is an example for the methods of amortization and comparing them to each other.